Well, good afternoon and welcome to this third CAFII webinar of 2025 on Insurance Lens, Credit Protection Insurance Consumer Profiles. My name is Keith Martin and I am the Executive Director of the Canadian Association of Financial Institutions in Insurance, or CAFII. On behalf of myself and the CAFII Board of Directors and my colleague and CAFII's research analyst, Robin Jennings, I'd like to thank you for joining our webinar today. CAFII is a not-for-profit association dedicated to the development of an open and flexible insurance marketplace. Our 14 members include the insurance arms of Canada's major banks and credit unions, along with their insurer partners, which underwrite credit protection insurance and travel insurance. Members of the audience, if you have any questions you would like to ask the panelists during this webinar, please send them to us as the host and using Zoom's Q&A function, and Robin and I will pose them on your behalf. At the beginning of 2025, CAFII commissioned Pollara to conduct a survey of CPI owners and the general population sentiment towards this product. This webinar will highlight the key findings from this survey. I want to mention that CAFII regularly commissions research, which we share with stakeholders, including regulators and policymakers, on issues related to our industry. We have commissioned studies with Deloitte on the impact of technology on insurance, with LIMRA on homeowners and their level of insurance, and with Pollara on digitization, as well as the current study on the attitudes of CPI holders towards their products. We believe that understanding our consumers better allows us to serve them better and is an important part of our activities. I will now turn it over to my colleague Robin Jennings to introduce our research lead, Leslie Martin, Senior Vice President at Pollara Strategic Insights. Robin?
Thanks, Keith. Hello, everyone. Thank you all for joining us today. It is my pleasure to introduce Leslie Martin, a 20-year research veteran. Leslie leads Pollara's Consumer Insights and Financial Services Division, as well as the Health Affairs and Reputation specialty practices. With a client portfolio that encompasses every sector, she specializes in uncovering the underlying beliefs and motivations at the core of relevant audiences. Leslie excels at discovering key themes that inspire targets, influencers, and stakeholders alike. Prior to joining Pollara, Leslie was a senior research and account lead at Ledger and Comscore, and led research departments at Sears, Cossette, and Great Gulf Homes. She has authored research-based articles in peer-reviewed medical journals such as Healthcare Quarterly, and her research has been featured in most Canadian newspapers, as well as marketing magazines. Leslie holds a BA in Business Communication from Brock University. Just before we begin the webinar, I would also like to extend a special welcome to a number of VIP guest attendees. In addition to many representatives from our 14 CAFII member companies and our 12 associates, which are key supplier companies to the bank assurance sector, we have VIP attendees today from allied industry associations such as the Canadian Life and Health Insurance Association, or CLHIA, the Travel and Health Insurance Association of Canada, or THIA, from insurance research firms LIMRA, and as well from many insurance and financial service regulators and policymaker authorities, including the following: the Insurance Council of BC, the BC Ministry of Finance, the Insurance Council of Manitoba, the Financial Services Regulatory Authority of Canada, of Ontario, or FSRA, Quebec Autorité des Marchés Financiers, or the AMF, the Government of Nova Scotia, the Financial Consumer Agency of Canada, or FCAC, and the Federal Department of Finance for the Government of Canada. Now to begin, I'll pass it over to Leslie to get us started. Leslie?
Great. Thank you, everyone. I'm just going to share my screen to show the presentation. And before I started, I'm going to apologize. I have a cold that just won't quit. So I am going to attempt to not cough through the whole thing. I'll do my best. Before I jump into the results, I'm going to tell you a little bit about what we did. We did a study of over 3,521 adult Canadians who have a mortgage or HELOC. And I just want to clarify, we did look at CPI holders, but we also looked at non-holders because we really wanted to get an understanding of this group overall and what insurance means to them, whether they have it or they don't. The study was conducted this summer in July of this year. So looking at the credit protection insurance segments. So as Keith mentioned, CAFII was seeking to have a deeper understanding of mortgage and HELOC holders and looked at both the CPI consumers and non-consumers. And what they really wanted to understand was pretty much everything about their financial life. They wanted to know their impressions and confidence in their current financial situation. How are they feeling about the economic climate? And how are they feeling with their own financial literacy? And are they able to manage what is going on? What are their worries for the future? What is their confidence in dealing with financial adversity? And what is their impressions on insurance? And we looked at both CPI and life insurance to really understand what insurance means to them and how it can help them, can give them more confidence, and help alleviate some of their worries. So segmentation analysis is a statistical technique that is used to divide a broad target market into smaller, more homogeneous groups based on these criteria. We can use it on many different criteria: demographic, psychographic, behavioral, or needs. But in this situation, that's what we looked at. And what was developed from this analysis is we found 6 groups of consumers. These groups, the respondents in these groups are quite similar to each other, but each group is very different from the others. Okay. Now, I know we said 6 and you're only seeing 4, but I want to talk about these 4 first. And we found 2 groups that could benefit from increased protection, and that is the confident planner and the anxious realist. And don't worry, I will be going into more detail about who these are in the presentation. We also had 2 segments that we need to maintain the protection. We need to make sure they realize what they're getting from the protection that they can get from insurance, and that's the stretched investor and the steady planner. I'm going to go into detail, of course. I just wanted to talk a little bit about how much of the population these groups are. So the confident planner and the anxious realist, those are the 2 groups that I said we wanted to increase protection for, and they make up about half of the population. The stretched investor and the steady builder, much smaller groups. They make up about 13% of the population. These are the groups that we're just going to maintain, make sure they continue understanding the coverage. And then we have 2 other groups, the settled saver and the comfortable traditionalist. These groups are less likely to understand the benefit or feel they need to have any kind of credit protection insurance. They make up about 1/3 of the population. All right, and looking at the individual groups, let's look at the confident planner first. We have named him Kai. Kai really has it together. He is in his early 30s. He's married. He's raising a young family. He takes pride in being that careful planner. He is confident. He has a high financial literacy. He knows what he's doing. He knows how to manage his household finances. He's already thinking about retirement and saving for retirement. He's keeping up with his bills. He's managing mortgages on multiple properties. He's more likely to have more than one property than some of the other segments. So he is doing quite well. He has a larger than average investment portfolio. And he's really focused on safeguarding his assets and protecting his future. But because he is a confident planner, he understands that you can't plan for everything. He understands that things could change very quickly. And we can see this in the anxieties on the right. The anxieties he's dealing with is job loss, keeping up with his bills, and economic uncertainty. So although he feels like, he has a cushion, he's feeling good, he's got it together, he does still worry about that economic uncertainty. He still knows that job loss could change everything very quickly. And for that, he likes to have something that gives him even more confidence. He values products like CPI because it does protect against this. It particularly that protects against job loss protection. It reduces stress, and it safeguards his family against financial uncertainty. So that makes him even more of a confident planner. When we look at Kai, he makes up 30% of the CPI customer base, the current customer base, likely to be retained 28%. So this is, are you likely to get renew your CPI protection if you renew your mortgage? Most of this group will, but we could increase this protection in this group by 12%. So there is still people that haven't gotten CPI yet who could really benefit from it and the confidence that it gives. Next, we have our anxious realist, and that's Crystal. And I always think Crystal is about the polar opposite of Kai, because Crystal doesn't have it together in the same way. Crystal is raising teenagers with her spouse, and she's navigating ongoing financial stress. And if you look at her anxieties, they are household bills, credit card debt, job loss, lack of confidence, and knowledge. Crystal is just living pretty much paycheck to paycheck. She's not being able to save money. She's very worried about being able to pay all of her bills. She's not even looking to the future. Like, even though Crystal is in her mid-40s, retirement planning, future planning, not on her radar because she's just trying to get by. She doesn't have a lot of confidence in her own knowledge. She's not very financially literate, and that scares her even more because she doesn't know what to do to provide the protection she knows she needs. Because that's the problem with Crystal. She understands that everything it's hanging by a thread. You know, there could be one thing, like if there was a job loss in her life, the house of cards would come crashing down. She does not have anything to protect her. So she wants CPI to be simple and built into mortgage. She doesn't want a lot of details. She doesn't want a lot of confusion. She doesn't know a lot. She doesn't feel confident in her knowledge. So if you sort of throw a lot of information at her, she's going to feel overwhelmed and back off. But she's also worried about her finances now. So she doesn't want another bill to pay, but at the same time, she does have the knowledge that she needs something to protect herself and her family if there is any kind of major financial shift. So that for her, it's a struggle between the protection she needs and the protection she can afford. So knowing that it's a simple and easy and affordable way to give her that protection, that might help Crystal. Crystal makes up 19% of the customer base. The customer segment likely to be retained is 15%. So there could be some loss there of people who are feeling that it's too expensive, they can't afford it, but there is a potential to increase this by 8%. Sorry. Now we look at Michael. Michael is the stretched investor. And the way I look at Michael is he falls right in the middle between Kai and Crystal, because Michael is balancing. It's a bit of a balancing act. Like, you know, he's balancing his current demands with his family, his children, his mortgage, his HELOC, his credit card debt. All of this means money feels a little tight to Michael, but he can still think about long-term goals. Like, he is not like Crystal in the point where he's just, I just got to get through today and worry about tomorrow. He is, when you look at his aspirations, financial security is in there. Becoming debt-free is in there, financial clarity. So he is thinking about the future. He doesn't have it, all together like Kai does, but, he is thinking about the future. He does manage his finances with some confidence. So he has a bit of financial literacy, but it doesn't translate so much into looking towards the future. He doesn't feel as confident about planning for his future. The difference with him too, and you'll notice these numbers here are a bit different on this slide than what we saw in the past, because 100% of this segment already owns CPI. So they are all CPI holders. Because the segment is relatively small, Michael makes up 22% of the customer base, likely to maintain coverage is 6%. So there's a lot of that mushy middle, and you can see these numbers off to the side here where potential to cancel is 4. So these are 4% of this 22% are saying, they're likely to not get it again for one reason or another. 6% are likely to get it again. And there's a 12% that are in the middle, that they're not sure. What is stopping them is just they're not sure if this is the right product for them in terms of affordability, in terms of value for money. Is it mostly affordability and value for money? They do have a financial advisor, but they rarely talk to them about insurance, so that they don't feel they have that person to go to get this information. So what they need is, like, Michael does see CPI as a convenient safeguard to protect his family from the unexpected. So he just needs to understand that it is a good value, that it is the right product for him. And we could easily, that 12% could be to move to maintain. Now we have Diljit. Diljit is what we call the steady builder, and Diljit is the youngest of our segments. He is in his mid-30s. He has young children. He's balancing home ownership, debt management, and future planning. So he is, even though he is younger, if you look at his aspirations, retirement security is in there. So he is still thinking about the future. He feels quite confident in his knowledge, but he's very pragmatic in his decisions. He is about housing, about rental ownership, about everything. He's considering tapping in through HELOC for flexibility, for financial cushioning. He really makes smart decisions based on information. This group overall is a bit different than the others, because the likelihood of steady builders having credit protection insurance is almost split down the middle. Half do, half don't. And this is why I said, like, in this situation, he doesn't, but his peers do. He is in the realm of understanding it. He just needs more information to determine whether or not this is right for him. Unfortunately, he's different than Crystal in the fact that where Crystal just wants to give me the top line, he does want the details. He wants to make sure that he's doing the right thing, because he is focusing on building and saving and not overextending. So he needs to know that what he's paying for is worth the money. Diljit makes up 12% of the customer base. Likely to be retained is 11%. So those who have it are likely to keep it. And there's like 2% chance we could increase it a little bit by 2% to get some of those other people into that group. Right. And we have Arthur, who is the settled saver. And Arthur, as I said, is the one that is not one that is likely to consider credit protection insurance. Arthur is older. He's nearing his 60s. He is looking for retirement. He's been married for over 20 years. He now enjoys an empty nest. His kids are grown. They're living independently. He has a comfortable lifestyle. He has investments. His big anxieties are about retirement, the retirement adequacy, long-term care costs, economic instability, and in maintaining investments, again, to get him through retirement. So that's really, and his aspirations are comfortable retirement. That's where his mindset is. So therefore, he's not likely to think that credit protection insurance is going to be right for him. Because he's really more just about the long-term planning for himself. And we can see this in that chart at the bottom, where the 56% in the red, he is very unlikely to obtain or renew credit protection insurance. He makes up 5% of the customer base, 3% will be retained. There is a little bit that may be growth, but this is definitely would be a harder target to get. To show the benefits of the protection, we'll say it like that. And their last target is Susan. And Susan is a comfortable traditionalist. Again, she is not really a target. She's our last segment, not really our last target. She is not one that we would recommend, simply because she's not seeing the benefit of it for her. Susan comes behind Arthur in terms of life stage, shall we say. She is in her early 50s. She is heading towards that steady stream of life with her grown children. She has one home. She is thinking about retirement. She's not as close to it as Arthur is, but it is what is in her mind and of what she's thinking about. She is balancing work, saving when she can. She feels fairly confident in financial management. She does have some financial literacy, and she is she remains cautious about the economy. So she is a bit worried about things like market volatility and what that will do for her retirement, about job loss. There is some issues there. She is concerned. And you can see that in her anxieties being market volatility, retirement planning, and long-term care costs. She feels unlikely to purchase credit protection insurance now, but she remains open to the product if she feels that it's practical and protective. So there is a possibility that she could be swayed into understanding that CPI could help her. And it would be a solution for her. It would be seen as a solution that safeguards against unforeseen events, and it provides a broader coverage and accessible coverage, right? So it's just if it was shown to her as a way to give her that support easily, then she could be swayed. And we can see this in that bottom graph as well, with the 24% in gray, and that's the don't know. So she is not dead set against it. Like Arthur was more, no, I'm not doing that. It's not something that's for me. She's likely to think probably not, but maybe, because she's not less likely to know. So we've said that she is not necessarily a target for this type of protection, just because she would be a little bit harder to convince, and her need for it is a little bit less than people like Crystal or Kai or Arthur, or not Arthur, sorry, Michael, who do have this insecurity, do have these concerns, and would be more likely to really benefit from this protection. Susan, she probably could benefit from it, but she might not need it as much. So those are the 6 segments of the population that we have found. I thought my next part of the presentation will be going into some of the actual survey results. So I thought I might take sort of a pause and see if there are any questions about these segments before I move on.
Hi, Leslie. So I'm looking at the Q&A and there doesn't seem to be any questions right now. I don't know if I can wait like 10 seconds. If anybody does have any questions they want to pose, do it now, and I will then vocalize them to Leslie. But it doesn't look like we have any at the moment.
That is fine. We'll always take questions at the end as well. So if
Yes.
as you're thinking about it and digesting it, if something comes to mind, feel free.
Sure, and I will reiterate that if you want to pose any questions in the Q&A, I will let Leslie know. I'll vocalize them to her. So let's continue on.
Perfect. Okay. Excuse me. All right. Now I'm going to look at a summary of the survey results. This is a very our final report was about 60 or 70 slides long. There was a lot of data. We looked at a lot of cuts to really understand this and to get through this analysis as well. So what I'm showing you now is really a summary, and it's pulling out some of the most important things we found. There is definitely more details that we can provide as needed. One thing that was really, really evident throughout this survey is that financial vulnerability. There is a lot of financial stress that people are feeling right now. And a lot of it, it's not only based on their own finances and where they are themselves, but a lot of it is also influenced by the economy overall. There's a lot of economic uncertainty right now. There's a lot of questions about what the future is going to hold. And that is really impacting people and how they're feeling moving forward, and how they're feeling about their own finances and how they're going to manage their finances. What we found is that only 30% of Canadian mortgage and HELOC holders feel positively about their financial situation. So that's just their current financial situation. 44% report current economic situations are negatively impacting their personal finances. So that's not even really the fear of it, but what they think is actually going to happen, that they are going to have some problems based on what's going on, sort of outside of their control, what's going on within Canada and globally. Half could only maintain their lifestyle for less than 6 months without a primary income, and half would have serious problems paying some of their bills if their main income earner was unable to work. So we do have that as well. And that is also adding to the stress that people are having, that they just don't have that cushion that they feel that they could weather any storm. And how this works for the segments is, this is particularly true among the anxious realist, which is Crystal, and the stretched investor, which are Michael, because these are the two that are particularly vulnerable to financial issues. They're struggling with affordability, and they're facing the highest exposure for financial shocks. So these are the two groups that are really feeling this more so than the other ones. Look at job loss, and that is, of course, part of what we were talking about with economic uncertainty, but I wanted to pull this out because I thought this was a very powerful finding of what people are worried about. We have almost 3/5 that fear that someone in their household may lose their job in the next year. So that's 58%. That is a substantial number of Canadians who are thinking that they might have to deal with the lack of an income in the next 12 months. Of these people, as I said, 50% doubt they could even last 6 months, but 74% couldn't last more than a year if they lost an income. So again, that's quite a staggering amount of people that don't have a financial cushion, that wouldn't be able to be okay if they were to lose an income. And 58% are concerned they might. And as I said, half would have some serious problems paying at least some of their bills, but 28% would have serious problems paying all of their bills if they were to lose an income. And that is saying a lot as well. Like, there is a lot of people who, if this does happen, they are going to have some problems. Only 1/3 feel knowledgeable when it comes to financially planning for their future. So again, we have this uncertainty in the air, and very few know what to do about it, right? They don't know how to plan. They don't know how to weather these potential storms that might be coming at them. And we have only 1/3 who regularly put money into savings. And that's a staggering amount as well. So only 1/3 of Canadian mortgage and HELOC holders, like on a regular basis, have money that they put into savings for their rainy day. There is just not that rainy day fund available. The confident planner, the anxious realist, the stretched investor, and the steady builder, that's the four segments that we were going to focus on, being Kai, Crystal, Michael, and Diljit. They're all concerned about job loss and what that could do to them, how that could send them into financial peril. So, and that's when we looked back at these anxieties and the worries, job loss was in all of them. Like, that is the one thing. And even people like the confident planner, like Kai, who knows that he does feel like he has some kind of cushion, they know that a job loss could come out of nowhere and could impact them greatly. Okay. Canadians lack confidence in their existing safety nets. And about their safety nets, I'm going to speak specifically about insurance in this. So now 38% only 38% are confident they could pay their mortgage if their primary earner had lost their income. If there was a job loss, whether it be for, death, disability, critical illness, whatever it might be, only 38% feel that would be okay, that they'd be confident in paying their mortgage. Only 34% feel very knowledgeable about determining the best insurance for their family. So that's quite low. So when you're looking at the financial literacy questions about, how knowledgeable are you about saving for the future and about managing your finances, managing your debt, etc., insurance is one that's quite low, with only 34% feeling knowledgeable about that. Now, half of these people do use a financial advisor, which is great, but half don't, for one thing. So half of the people don't have a financial advisor, but even those who do, very few use them for advice on insurance coverage. So that's 20% of those who do have a financial advisor. So really only 10% of the population talks to a professional financial advisor to get information on insurance, which they don't have because they don't feel knowledgeable about it. We asked how long a life insurance policy should last. Like if they needed it, if a primary income earner were to pass away, how long should a life insurance, not how long would it, but how long should it? 35% said they didn't know. So right away, even not only do they not know a lot about insurance, they don't know how much coverage they should have. So we also talked to those who have life insurance about how long the insurance would last them. 41% didn't know. So these are people that have an insurance policy. 41% do not know how long that this money would last them. And another 44% believe it would be under 7 years. So it shows that even if they have insurance, it's not really giving them the coverage they need, or even they don't know if it is or not. Who knows? But when we ask them, do you have sufficient life insurance? So again, talking to the people who have life insurance, do you have sufficient life insurance to protect your family in case of an unexpected event? 73% say yes. So this confidence, because it is quite confident, 73% say, yeah, I have enough life insurance, is quite confident, but this confidence appears to be more emotional rather than informed, because clearly, even when we say, okay, yeah, I feel I have enough, well, so how much do you have? Oh, I don't know. So there's definitely a gap there between having insurance and being secure with the insurance that you have. And this is particularly true of the stretched investor who questions the CPI value despite having it. Even the ones that have it question the value, or sorry, the ones that they do have it, so they question the value. And the anxious realtor, which is lacking the confidence and financial knowledge of what they need. Now I talked about, I'm putting it in quotes and big quotes here, the middle range income. So I looked at people who have a household income of between $120,000 and $250,000. Now these are all homeowners, don't forget. So, you know, it's a little bit higher income than normal, than on average. But these are still, that's quite high, you know, 120,000 to 250,000, but they're still feeling the financial insecurities. They are not feeling secure in where they are. 59% are concerned about current expenses and 75% are concerned about saving for the future. 46% have debt outside their mortgage or HELOC. 26% of this income is carrying a mortgage, HELOC, and other debt. 25% of people with a household income of 120 to 250 are living paycheck to paycheck with no ability to save on a regular basis. 48% would have problems paying bills if there was a loss of income, and 54% do not believe they'd last 6 months if there was a loss of income. This more income does not mean more knowledge when it comes to life insurance, because 4/5 don't know how long their insurance would last, or think it would last less than 7 years at 45%. So most of them think that most are underinsured. The other thing is that they are not more likely than the lower income group to carry CPI. And I thought that was an interesting finding, because I know there's sort of a thought that insurance is for people who can afford it, that people who don't have insurance are just people who can't afford insurance. That's not the case, because they have the same likelihood of people with a household income of under $120,000 to carry CPI. And 1/3 of the stretched investor and the confident planner are in this income group. Okay, so when we look at CPI holders and what do they think of CPI? So they appreciate convenience but question value. Now, first of all, before I get into the details, because I think that headline can be a little bit misleading, I want you to understand that CPI holders feel very positively about their product overall, all of it. Convenience, value, all of it. There is a majority who feel positively about it. But when we look at convenience and effectiveness, it is higher. So 80% at least somewhat agree, and 40% strongly agree that it's convenient. 77 somewhat agree, 36% strongly agree that it is effective. And then when we look at provides good value for the money, and those who strongly agree, it's 30% is affordable, 29%, and is trusted more than other insurance, 29%. So these are a little bit lower. Now, it is also, I just made the note that it's harder to get a higher score on that. It's not a bad score, because if you talk to anybody about any product in any industry and you talk about value for money and affordability, it's always going to score a bit lower, because, you know, everything could be more affordable. So it is harder to get that up, but there is that little bit of a gap there between what it gives and like convenience and efficacy versus value and affordability. However, and again, saying that it is positive, only 10% of CPI holders say it is unlikely that they'll renew their CPI if they were renewing their mortgage. However, when you look at non-holders, 46% of non-holders are unlikely to obtain. So it's much higher among the people who don't have it now. However, you know, it's just interesting to keep this in mind, because it is sort of lukewarm perceptions of value and affordability. It could create retention vulnerability and limit positive word of mouth, because you just, you know, there is a lot of, people are getting a lot of information from a lot of places. And then in the segmentation context, even the confident planner who values the CPI more strongly shows moderate rather than enthusiastic support, and suggesting room to strengthen the value proposition across all segments. And now looking at the non-holders, again, like just looking at the affordability and trust, it is a dual barrier to CPI adoption. And again, well, as I said, while the CPI holders feel more positively, they feel a little bit less about value. Non-holders are also less sure that the product provides value for the money, is trustworthy, and is affordable. Keeping in mind that they're not sure. It's not that they feel negatively about this. It means they literally said, I don't know. They don't know. The reason why they didn't obtain this coverage is often due to expense, particularly 2/5 said it was due to expense, either that particularly that was too expensive or it was not good value for the money. And non-holders who feel less positively about their current financial situation, or who are less confident in their ability to manage their finances, are less sure of the product's affordability and trust. So you have to look at that. The people who are in trouble or don't know what they're doing, they're the ones that are more likely to say, oh, I don't know if this is affordable. I don't know if this is good value. And this is the anxious realist right there. It's Crystal for sure. She sees it as CPI as both protection and another bill to pay. So that is a problem for her. Those older, the ones that we don't talk necessarily about wanting, that would be easy to get to have this protection, they also question the trustworthiness of value despite having assets to protect. And what is going to drive purchase intent of CPI? What is going to make people want to get this coverage? They're more likely to make the change, want to get this coverage for the economic triggers. Particularly financial situations make bill to pay or debt management more difficult. 44% say they're more likely to get CPI for that. 39% if there's economic uncertainty or turmoil. 37% are more likely if it's due to the rising cost of living. So those are a lot of the financial problems. If there are financial economic triggers, people are more likely to say, okay, maybe I do need to have this coverage. 34% are more likely due to major life events like marriage or children. And the CPI features that resonate are family protection, stress reduction, and protection against unforeseen events. So although there is the financial triggers that are going to make them consider getting CPI, but it's the feel good of it that they want to know that they're protected. And these triggers resonate across all segments, but are particularly relevant for the anxious realist who are already struggling. the stretched investor who are balancing competing priorities between, saving, paying, all of that, and the confident planner who really does value protection against risk. Awareness and understanding gaps limit increased protection of CPI. So again, I'm going to look at the non-holders here. So only 36% of non-holders recall being informed about CPI option when they got their mortgage or HELOC. 60% do not recall being offered. So this doesn't mean that they weren't, of course. It just means that as they walked away, it left their mind kind of, they don't remember if they were offered it or not.
Leslie.
Yes.
Sorry to interrupt. We just got a question in the Q&A. I'll read it to you. Someone said, expensive and not value for money are of course reasons, but did non-holders mention anything along the lines of, I don't have a policy because there was nobody to explain the benefits to me. So i.e. like a lack of knowledge.
We're getting there right now, actually.
Excellent question.
Right. Yes, there is definitely a lack of knowledge for sure. And they do have, and I do think that is coming up, but anyway, so as I said, so there are 60%, one that don't even remember being told about it. And as I mentioned, it doesn't mean that they weren't. It means that for whatever reason, they didn't think they knew about it. They didn't think they had that information. And 24 to 30%, 32% of non-holders do not know enough to rate CPI on any of the attributes. And that's a big finding as well. And it might not sound that big, but it really is, because 24 to 32% are the people who said don't know. So it's not that they feel negatively about any of the CPI attributes. They simply don't know. They don't know what it has. They don't know what it offers. And they just don't know. And there's also 40% of non-holders cite a lack of need. And it's not, again, it's not that they don't have a need, they don't understand that they have a need. You know what I mean? They definitely have a lack of understanding. And to break that down a bit more, 23% said they didn't have a need. They just didn't need that kind of coverage. 13% had other insurance. And that's only 13% as well. And well, half have another policy to cover life. So of these people who said, I don't need it, you're looking at half of them are who actually do need it. They don't have another policy at all, but half do have another policy for life, but very few have policies for disability, critical illness, or job loss. They don't have that coverage. And again, when we're looking at the lack of safety nets and the lack of savings and the financial worry, this is a huge finding that they just don't have that coverage, but they don't seem to think that they need it. Then another stat that I wanted to pull in here, because I found it extremely interesting, and this was for everyone. It's not even just non-holders, but we asked people, do you think insurance is important to protect your family when it comes to unexpected problems? That's not the exact wording, but generally that was what we asked. Only 50% say insurance is very important. And I found, and it wasn't like, do you have insurance? Do you have enough insurance? No, it's just overall, do you think it matters? And only 50% say it matters at all, which I thought was, honestly, I found that one kind of staggering, because I would have expected that to be higher, that people, even though I do this all the time, I know this is the way it works. Oh yeah, and so many times you have, yeah, it's really important. Do I have it? Well, no, but it's important. I know I should, but I don't. This wasn't even that. This was only 50% who thought it was important. So there's definitely a lack of awareness of what they need and what it can offer. In the segment context, is the steady builders and the comfortable traditionalists lack confidence in the CPI's value and trustworthiness. They require clear information about protection, accessibility, and cost effectiveness. But even when we're looking at the other segments that are more easy to get, they need to understand the need for it. Okay, so looking at CPI's protection, it is strong, but coverage gaps exist. So 29% of mortgage holders and 22% of HELOC holders have CPI. The coverage types among those who do, life is quite popular. There's a lot of life coverage at 94 and 96%. About 4/5 have critical illness coverage or disability coverage. Job loss is much smaller. Only 60%, 66% of mortgage holders, 73% of HELOC holders who have CPI have job loss coverage. So that is one that isn't as high. And among the CPI holders under 40, most of them, like 79 to 95% of those under 40 have job loss coverage. But when you look at over 40, it's only about half of those over 40. And you can say that those people over 40 are maybe even more they're in more danger of this. So there is definitely an opportunity to enhance overall protection available to Canadian mortgage and HELOC holders, and particularly about job loss, because there is a big concern about job loss. Like, again, going back, 58% are worried about job loss, and they don't have the coverage that they need to protect them from it. Right. Financial institutions are the primary distribution and influence channel for CPI. So 53% purchase CPI from a financial institution, particularly a bank or credit union. Among non-holders who were aware, 94% of those who were aware of CPI learned about it from a professional, with 67% saying it was specifically from a bank. 33% prefer applying for CPI through a financial institution. And this is 26%, and this is overall. This isn't looking at CPI, but overall 26% are dependent on financial institution representatives as a source of financial information. Okay, now I'm going to get into a lot of the appendix and the details, so I'm going to leave it at that. So I will stop sharing, and yeah, we'll see if we have any questions.
Great. Thank you, Leslie. I know I have some questions for you, but I will keep, obviously, for audience, the Q&A is still open, so pose questions freely. But while we wait to see if anybody has any questions, I'll ask mine.
Sure.
So we'll start with the question, how can the segmentation analysis like this one provide Canadians, more Canadians with protection that CPI can offer? How does this help?
Well, it really helps because it allows us to understand the needs, the fears, the wants. It really allows us to understand our consumer. And as we see, like the credit protection insurance, it's sort of, it provides everyone the same thing when you look at the product, but when you look at what it's giving them, it's very different. You know, for some people, it's giving them protection. For some people, it's giving them confidence. For some people, it's allowing them to know that their world isn't going to crash down if something happens. And so by knowing how to talk to people and understanding what they need, we can really focus on what we can give them and how we can show them that this protection is something that is going to be really helpful for them.
Nice. So like a sense of security.
Exactly.
My next question is, you talked about the middle income group in your presentation. Could you explain or elaborate a little bit more on that group?
Yeah, and I thought that a group was really important to look at, because I know there's sort of a perception of this, because I call them, as I said, I call them middle income, but really it is quite high, 120 to 250. And there was this idea that these people are going to be the people who have it more together. They're going to be the people that have more savings. They have more of a safety net. They have insurance. It's not the case. These, like, just because you're making, like, you have a household income of over $200,000 a year does not mean that you're sitting back and relaxing. You're not. You're still struggling, and you're still worried, and you're still balancing and stretched out and trying to figure out. And you're not more likely to get insurance coverage than a lower income. And that, I think, is really important to keep in mind. It's not, income is not the primary driver of insurance. It's just not. People with higher income also don't have it at the same level as people with lower incomes.
Yeah, that 250, that range did surprise me. 250 seemed high, but then to your point, this group of people are still struggling.
Yeah, they are still struggling. And I think it is a good contrast to see that it is considerably higher. Like, if you look at just the average income in Canada, it is much higher. But in today's world, and that also comes into the economic confidence, right? There's, with everything that's going on, it's everyone is having many of the same concerns.
We're all in it together, kind
We're
of.
all in it together.
We got a question in the chat that, so I'll ask it. Were there any results in the survey or the profiles that surprised you or have changed dramatically from previous years? So anything that shocked you?
Well, in previous years, we didn't do a lot of the financial and how people are feeling as much in previous years. As I said, the one that really surprised me was the lack of understanding of how important insurance is. Like that one floored me. The other one was the savings. And that only like 1/3 of these Canadians are regularly putting money into savings. And whether that be saving for the future, saving for a rainy day, like saving for any kind of saving, there is a lot more living paycheck to paycheck or pretty close to it than I thought. That one was very surprising to me.
Yeah, that was surprising. And people's perspective of the importance of insurance being 50%, that was also really surprising.
Mhm.
Um, And then, so that you mentioned that many of these Canadian homeowners are not feeling positively about their financial situations, yet they also do not have the proper safety net to protect themselves. Why do you think this is?
I think there's a lot of lack of knowledge, and we saw that in like, so there's the groups of people like the Crystals who don't feel confident in anything that they're doing, in any kind um, of their financial literacy and managing their bills and managing their debt. Then you look at the other people like the Michaels and the Diljeets who who feel quite confident, but they're confident in their day to day. They're
Mm,
confident in their ability to manage their finances, to manage their debt, to, budget themselves, like to have that. But when you look at future, there's much less confidence. There's much less confidence in planning for their future, in understanding what insurance to get, in all of that. There's just, people don't understand it, and they're not. Um, they're not, even the people who are thinking about the future, they're not putting as much planning into their future. They're not putting enough learning into their future, and so therefore they don't know what they need. And so they're thinking. We saw that with the insurance stuff as well, with 73% saying, "Yay, I'm fine. I've got enough insurance." But wow, they have no idea how long that insurance is going to last them, and they don't have enough insurance. Like there was a pretty high number. As I'm doing math in my head, it was almost a third who thought it was going to be less than 2 years that their insurance policy, and they were okay with that. Well, my insurance policy is going to last me 2 years, and they thought that was fine. And so that is that's just the lack of awareness. I think that is really causing people not to have that safety net.
It definitely reinforces the importance of, financial literacy. And
Yes,
as we approach November's coming and that's financial literacy month, just reinforces being like, we need this
we
information
do
needs to be
need to
out
have
there.
that,
Yeah.
definitely.
Um,
Yeah,
My last question. So you pointed out that confidence in life insurance appears to be informed by emotions rather than
yeah.
analysis. Why, could you elaborate on that? Why do you say that?
Well, I'd say that exactly from what I was just saying to answer the last question. That the 73%, again, I guess that when we were talking about the staggering, that number was staggering to me as well. And it wasn't at first. You look at it, 73% feel they have enough life insurance. Fantastic. That's great. Because that's a great number. And for 70, and if the number was 73% have enough life insurance protection, it would be a different story, because that would be a good number. Like really, that's a pretty high number. But then when you looked at what they have, it was so much less. And really, there's a lot of that 73% are feeling good because they have a policy. You know what? I have a new life insurance policy, good for me. I'm set, without understanding what they have, that they don't have enough, that it's not going to cover them. And if they are um, faced with that situation, there's going to be some problems for them, and they don't even know it, because just emotionally they're thinking, great, I have an insurance policy, I'm good.
Yeah, I mean, being a millennial and my friends starting to buy homes and talking to them about CPI or any of this sort of stuff, I know that they don't know. There's such a lack of information, of knowledge, and then on top of that, then a lack of confidence in purchasing products. And I can attest from like a firsthand experience that like that, it's all there. So
I have to tell you, I am not a millennial. Clearly not. I have some friends who I just recently, just on the weekend, was having the same conversation with about their mortgage. So I don't think, and I don't think it's even an age thing as much as it's just is a lack of knowledge.
yeah, this has been so interesting. Thank you so much, Leslie. I don't think we have any more questions in the chat, but the ones we have gotten excellent. So I'll just ask Keith to hop back on to just close down the webinar. But thank you so much. This was great.
Terrific. Well, thank you very much. I just want to briefly mention that we will have another webinar in October 30th. It will be with Swati Agrawal of Ontario regulator FSRA. She has led the efforts that an international regulatory body called the International Association of Insurance Supervisors has been moving forward with around DEI initiatives internationally. And so Canada's played a leading role in this through Swati, and she will be sharing her insights and the report that they produced and some of the activities internationally that we have learned about in terms of international regulation around DEI. So I hope many of you can join us for that. It will be you will be receiving an e-blast in short order. In the meantime, I want to thank Robin for moderating the debate and Leslie, just an outstanding job as always in terms of sharing these insights. We will be posting the full presentation, including all the additional slides that Leslie referenced, on our website in English and in French in short order, and we will be issuing a press release in short order. This webinar was in particular an opportunity for regulators and policymakers to have an advanced look and exposure to the research before it's fully publicly released, and that next step will be happening very soon. So Leslie, thank you again. We always appreciate working with you. And to all of those on the webinar, thank you for joining us today. And Robin and I wish you a great rest of your day. Thank you and bye-bye.